Good afternoon and welcome everyone. Thank you for joining our webinar on COVID relief updates and tax guidance brought to you by the Markham CPA firm and BankUnited. I'm Brian Clay, Executive Vice President and Commercial Banking Managing Director with BankUnited. We're very fortunate to have two all-star partners from Markham with us today, Ashley Forum, Tax Business Partner, and Andy Allen, CFA Advisory Partner. Ashley is with Markham's Tax and Business Services Division, where she provides tax planning services to privately held businesses, including tax consulting, compliance, research, and tax controversy issues. Andy is a partner in Markham's advisory practice. He specializes in business valuations, intangible asset valuations, and litigation support. During our time together today, we'll get to hear from Ashley, who will walk us through about a 20-minute presentation on tax relief and the current federal government administration's tax proposals and planning considerations for your benefit. Andy will also weigh in on topics of interest within the presentation. Then we'll have about a 25-minute question and answer session, which you can all participate in by using the chat feature to type in your questions on the presentation or on any other topic of interest that you may have. For example, unemployment, GDP, stimulus, interest rates, or inflation. And I'm happy to chime in on some of those as well. Before we kind of turn it over to Markham for their presentation, which we'll also put up on the screen. I will say that you probably know Q3 was a strong quarter for GDP and unemployment. You know, both had good rebounds, but Q4 was a bit more moderate. Q1 is expected to be a little bit slow as well. GDP in the fourth quarter was 4%, which is great. But annualized, you know, it was still 3.5 on the year. But for this year, Q1, Q2, Q3, Q4, what we're expecting is 2.3%, 4%, 4.7%, and 3.8%. So that's pretty robust. I mean, it is coming off of a down year, obviously, but a nice clip. For comparison, you know, in 18, you know, GDP growth was 3%, 2.2% in 19, and then, like I said, we hit the minus, you know, 3.5 last year. But 4.1 is the expectation for this year, and 3.5 next year. So, you know, that's you know, obviously very positive, and you've seen some of the, you know, the lift in the equity markets. Unemployment has continued to recover. 2020, for example. We started the year at 3.8%, and it spiked at 13.1 in the second quarter. But it's been coming down, you know, gradually ever since. 8.8 in the third quarter, 6.8 in the fourth. We're projecting 5.8 for the first quarter, 6.1, sorry, for the first quarter, and then 5.8, 5.5, and 5.2 for the year as each quarter goes on. So lots of good economic indicators on the GDP front. And on the unemployment front. On the inflation front, I'll say that we've seen, you know, kind of inflation tapering down over the years. 2018, 2.5%, 2019, 1.8%, last year, 1.4% inflation. So this year we're expecting 1.7%, so a slight increase, and next year 1.9%. But still, you know, below the Fed's 2% target. And if you think about all the stimulus that's coming in and everything that's happening, you know, to keep that inflation in that level, you know, that's actually, you know, a solid, you know, job overall, you know, by our Fed. Interest rates have been quite the story. You know, the Fed, you've heard, is vowed to keep short-term rates low. Fed funds, deposit rates, the prime rate, LIBOR, SOFR, things like that, well past an accomplished recovery. However, and that's been the case, but long-term rates, not so much. The 10-year rates have really moved from last summer when they were about 50 to 60 basis point range. And we've seen them come up about 12 to 15 basis points per month. I was looking today and I saw intraday was 1.31 on the 10-year treasury. Still very low, but basically, you know, the 10-year yield has doubled. So, you know, while the Fed is going to hold tight on the short-term rates, which they can control overnight rates, the market is kind of dictating. And the spread between the short-term and the long-term rates, it's about 200 basis points on average. Historically, it could be anywhere from negative to 400 basis points, but that is widening. So something to definitely keep an eye on. that impacts businesses in terms of borrowing rates typically, if you look long term. So like I said, rates are still historically low. So we can talk about a number of those topics: stimulus, inflation, GDP, and whatnot. But for our presentation, Ashley's going to walk us through, like I said, about a 20-minute presentation, and then we'll do a nice Q&A. So please use the chat. I'll be monitoring that and writing down notes and on the second half of the presentation. So thanks for joining us, Ashley. You're up. She might be on mute.
Okay, now you can hear me?
Yes.
Okay. Hi, good afternoon, everyone. Sorry for the technical difficulties. My name is Ashley Forum. I am a tax partner with Barcum, and pre-COVID days, I am out of the Fort Lauderdale office. I am going to share my screen because we did put a nice PowerPoint together for you. And it is telling me only the host can share in this meeting. Donna or Christina, I'm not sure if you guys have the slides, and Zoom wants to allow. What's that?
I think you were just assigned co-host, so maybe try again.
Okay, got it. Hold on a second. Maybe I'm not picking the right screen. Here we go. You're sharing the screen. Do you guys see the PowerPoint slides or no?
Not just yet, Ashley, but I did see it come up for a second. Right now, it just says you've started screen sharing, but it's a blank screen.
I think it's loading.
I did see it come up, so she might have to just pick the screen in the screen share.
All right, forget the slides. I don't think anyone really wants to read about taxes that badly anyway. So Brian, maybe you can send them out, or we can send them out to everybody.
No problem.
Okay, after the presentation. Okay, so let me actually, hold on a second, you guys. Because now I just lost them myself. Hold on. Okay.
Right.
Here we go. Yes? Okay. Okay, so basically when COVID hit, there was something that came out called the CARES Act, which I'm sure many of you are aware of because that was what the PPP loan program was included in. Right now, we are in the middle of tax season for the 2020 tax filing season. And so there's some things that I just want to point out and make sure you have at least heard of these by now, because they can become important in terms of this tax filing season. And, you know, these all were really geared to put money in taxpayers' pockets to help with this whole COVID pandemic that, you know, the world is going through. So a couple of things to point out are net operating losses. So part of the CARES Act is if you incurred a net operating loss for 2018, 2019, or 2020, you're able to carry back that loss 5 years. And what that allows you to do is carry that back to a tax year where you have paid taxes and you can request a refund of those taxes because you're going to use that loss to offset that income in one of those years, which sounds great and all. But one of the practical aspects of doing this that I want to point out and just remind everyone of is that if, let's say you did incur a loss in 2018 and you carry this back to a 2013 tax year to recover this refund, just keep in mind that first of all, that 2013 tax year is probably closed from the statute of limitations. So you're opening up a statute and then you're putting this in front of the IRS eyes for a second time, right? So if you did take an aggressive position in one of those years, just consider those factors in terms of cash flow and the actual refund you're going to receive, and maybe, you know, an aggressive position you took on a tax year that could actually be closed and the IRS wouldn't be able to open up that year again. Another thing I wanted to point out, and this can get a little technical, so I'll spare you guys the tax technical conversation about this, but again, it's important for your 2020 tax season filings. Back in 2018, under the Trump administration, we went through something called the Tax Cut and Jobs Act, which I will, oh, there you go, which I will refer to this presentation as the TCGA, because that just sometimes gets to be a mouthful. And so this was, and there was a lot of tax cuts in the Tax Cut and Jobs Act, but this was one of the revenue raisers that was in there. And this basically applied to the larger businesses, to where your gross receipts were over 26 million. Again, I'm speaking generally because there are some other technical things in this. So if your gross receipts are over 26 million, your interest expense deduction may be limited. And what I mean by that is it's going to be limited by 30% of your EBITDA. So if you had $100 of EBITDA, you take that and multiply that by 30%, you're going to be allowed $30 of an interest expense deduction, and anything over and above that is carried forward to the following year, and then you have to meet these requirements in the following year. Well, under the CARES Act, they increased that limitation from 30% to 50%. So that's important to note for this year, because you can get an increased interest deduction. Another thing that's really important that can be missed is that what they allowed you to do is you can take the EBITDA for the 2019 tax year to apply this 50% threshold. So if your 2019 EBITDA is higher than 2020, that's going to give you more of a tax benefit in terms of taking the deduction for interest. So again, it's something that you would have to do on your 2020 tax return that we're in the middle of preparing right now. Okay, one more item. Us as accountants, we're very excited about this technical correction. This relates to qualified improvement property. So if you're a lessee or if you're a building owner and you made improvements to an interior portion of your building, and it has to be a commercial building, not residential, you may be able to write off those improvements now 100% under bonus depreciation rules. And why that's important now is because, again, under this TCGA back in 2018, that was basically a complete overhaul of the tax law, which they wrote overnight. There was a technical error in the way they drafted it, and we thought this was going to be written in the law then. Unfortunately, we got stuck with depreciating this kind of asset over a 39-year life, which is not favorable to the taxpayer. So now under the CARES Act, they actually went in and they fixed that technical correction to where we can write off these assets 100%. But they made this retroactive, so we can actually go back to 2018, 2019, and possibly take those deductions in the current year, or we can consider amending those prior year tax returns. So again, these all could be potential write-offs in the 2020 tax year that would reduce your overall tax liability, and everyone likes to pay less taxes, right? Okay, so next slide, please. Okay. So this is the Employee Retention Tax Credit, which I will refer to the ERTC going forward. Okay, so this has kind of been a hot topic, you guys, over the last couple of months. I've been on the phone with a lot of clients about this, and it's important because there was a tax law change made in December, just a couple months ago under the Trump administration, which I'll refer to as the CAA. And basically, this Coronavirus Aid Relief Act extended and modified the ERTC. A lot of you probably never paid attention or heard of the ERTC because before this extension and modification, basically, if you received the PPP loan, you did not qualify for the ERTC. So majority of our clients and majority of business owners received some form of PPP funding for the 2020 tax year. And again, if you did, then you didn't qualify for the ERTC, so therefore it wasn't that relevant for 2020. Let me just explain how you qualify for this, because it'll be important as to how they extended and modified this. And I'm going to keep this short and sweet. I promise I won't bore you guys too much. So if your revenues decreased by 50% quarter over quarter from 2020 to 2019, or you were required to be shut down by a governmental order, those were the eligibility requirements. Now, another thing that came into play was the number of employees you had. So if your business had less than 100 employees, it didn't matter if you paid these employees for actually working or for being at home and not actually not working, but you were still paying them wages. If your company had over 100 employees, the only wages that counted for this credit were the wages that you paid to employees that were not providing any services for your company. So you were basically paying them even though you guys, were shut down or if they were laid off. So that being said, what is this actual credit? The credit that you were allowed to take was 50% of the first 10,000 of wages that you paid an employee. So for 2020, the maximum credit you could get was $5,000 per employee. Okay, so now we fast forward to December and we get this new extension and modification. Basically what it did was it extended this credit through June, the end of June 2021, so we can take it for the first 2 quarters of 2021. And then on top of it, what they said was, okay, if you took PPP money in 2020, you now can take the ERTC. The only difference is you can't double dip on the wages. So if you use those wages for your loan forgiveness calculation, you have to have some left over in terms of using it for the ERTC. So it's really going to apply when you get to take advantage of both of these. It's going to be the higher wage earners that you're paying. What was great about this in 2020 and where if you didn't have a decrease in revenues by 50%, they actually relaxed that to 20% for 2021 revenue. So if you look at your first quarter of 2021 and you compare that to your first quarter of 2019 and your gross revenue decreased by 20%, you could qualify for this credit. And again, I know a lot of people pivoted during, this whole COVID era and they cut costs and, some people did profit even with this whole COVID pandemic, which is great. This is talking about gross receipts. So keep that in mind. It's not profit or net income. So still take a look and have somebody go in and look at your gross receipts to see if you qualify for this. Another great thing they did in 2021. Yeah.
And I was just going to add on to this. I happen to be on the board of the Museum of Discovery and Science in Fort Lauderdale, and we had our finance committee meeting this morning at 8, and most of the meeting revolved around this topic. We do qualify for this because we were shut down by the government. The facility was, and we did continue to pay. So we actually did the same math this morning. We took out the PPP1 money, just like you described, spent about a half an hour, and ultimately we qualify for 6 figures. So we're this is a real thing.
Yeah, that's excellent. Yes, because it includes exempt organizations as well. It's not just for-profit companies, which is great. So the one thing too that I wanted to point out in terms of this credit and another modification that they made was now they increased the credit to 70% of the first 10,000 of wages, and it's per employee per quarter. So in 2020, the max you could get per employee was 5,000. Now in 2021, you can get 7,000 in the first quarter and 7,000 in the second quarter. Another good thing too, remember I mentioned that 100 employees threshold. For 2021, they increased that to 500. So if you paid employees, whether they were working or not, their wages are going to be able to be included in this calculation. We have a large client who owns hotels and restaurants. So you can imagine the impact that, you know, COVID has had on them. Thankfully, in 2020, their receipts didn't decline by more than 50%, but they did decline by more than 20% for 2021. And then they met all the other eligibility requirements. And they probably have around 300 employees. And I just helped them look at they did like an Excel schedule that had by employee, what the wages they paid them each quarter, and then did the formula with the 70%. And they are getting around a $2 million refund, you know, based on this credit. And one other thing I want to point out is this is a function of your payroll tax form. This is not something that's going to go on like your federal income tax return. This is basically what like your ADP or Gusto, what your payroll service company you're using, they should be very educated in this topic. And it's going to be something, you know, obviously you provide them with the information, and that credit, that refund is going to go on this form. And then that's where you'll receive the actual refund. Keep in mind, PPP was free money, right? We're allowed to deduct PPP expenses, and the income is not taxable income when it's forgiven. ERTC, when you do receive that refund, that is going to be a taxable event to you. Like it actually reduces your wages, so it is an income event. So I just wanted to point that out. Brian, when do you want, I have some more to go over. I'm just looking at the time and wondering when you want me, how long do I go for?
Oh, you're good. You're good. We have 15 more minutes, and then we'll do Q&A for the last 20 minutes.
Okay, and I'll save like the last 5 minutes for you, Andy. Okay, so we can go to the next slide. Okay, this is still, again, just for you guys' reading when you want to go to sleep later. Just go to the next slide, please. Okay, so Biden's tax proposal and planning considerations. Again, another hot topic. And, you know, this is not like anything political whatsoever, but sometimes, you know, presidents do things in their campaign for votes. So this was included in Biden's tax proposal. Is this actually going to come to fruition? We don't know. I mean, you'll hear accountants say all the time, like, oh, we don't have a crystal ball, because we don't necessarily have the answers. But we can just tell you what was, you know, included in their campaign, what we think may happen, and at least want you guys to be aware of, you know, where Biden's tax proposal was going. And basically, tax rates would change and increase for those wage earners making more than $400,000. You'll see I'm going to go over a few of these items, and everything is geared to more than $400,000 if you're making more than $400,000. So just keep that in mind. Also keep in mind, going through this, it's not as easy to get a tax law passed to increase tax rates, even if it is for the most liberal. It's still not the easiest thing to do, right? I mean, when they want to cut taxes, yes, there's got to be some revenue generators in the bill as well, but it's still just not as easy in order for someone to come in and just increase tax rates. Okay, so that being said, the current law, our highest tax rates for individuals is 37%. Biden's proposal is to increase that tax rate back up to 39.6, which it was before Trump did the whole Tax Cut and Jobs Act. And again, it's geared to those making more than $400,000 a year. Okay, the next item was itemized deductions, and these are your interest expense on your house, your real estate taxes, which is capped at $10,000. I'll go through that, and your charitable contributions for those of you that itemize. Right now, you are getting the full benefit of those itemized deductions minus that whole $10,000 cap for state income tax and real estate taxes. But you're not getting a phase out on your other itemized deductions based on your income level. Biden wants to implement a phase out of these itemized deductions for those earning more than $400,000. Another item, qualified business income deduction. Again, this was another tax cut under the Tax Cut and Jobs Act back in 2018, and a lot of businesses qualified for this. It basically gave you a 20% deduction of your income, which essentially takes your 37% tax bracket down to about 29.6 if you maximize this benefit. Biden does want to do away with this for those making $400,000 a year. So you'll see the general theme here, right? Okay, C corporation tax rates. Those went from 35% to 21% under Tax Cut and Jobs Act. And Biden is proposing to increase those to 28%. If you can go to the next slide, please. Okay, one other thing is payroll taxes. So once you make $137,700 on your wages, the payroll taxes stop coming out of your paycheck because there's a max. And anything you make over that, you don't get the Social Security taken out. Biden's proposal is, okay, keep that cap from 137 to 400,000, and then once you get over the 400,000 wage amount, then Social Security taxes are going to be implemented again. So again, you see the general theme here. Okay, so what can you do in terms of planning? Currently, as it stands, we don't have a tax law change under, Biden's administration. There was a proposal that came out, I believe it was sometime this month, and it referred to like the American Rescue Plan. There was really no significant changes in there in terms of like tax law. That was really, they wanted, to do the additional stimulus check, and that's when they were talking about increasing the minimum wage, those types of items, but there was nothing in terms of like tax rates with individuals or any kind of business tax law in that rescue plan. So generally speaking, when we have, in November and December is really busy for us because that's when we do our year-end planning with our clients. So we sit down with them, we do projections, and that's really where we like to add value in terms of tax savings. And if we can, do an R&D or a cost seg or some kind of planning. And the general theme is accelerate deductions and defer income, right? But if we have a year where we're going to have taxes increasing, then the whole way of an accountant usually thinks becomes reversed, right? You actually want to accelerate income and defer deductions. So you want to get more bang for your buck by pushing out a deduction into a year where you're going to have a higher tax rate. Again, this all depends on each individual client. It depends on cash flow. Because again, it's still tough to tell a client to accelerate income because it just goes against the way we think. But at the same time, if you're going to save a substantial amount of cash or a tax on that in terms of a tax rate differential, right, then it is going to be a planning tool. So what do I think? I don't think necessarily that they are going to increase taxes retroactively and make that retroactive to 2021. I'm not saying I've been around that long. I've been practicing for about 17 years, but I've never seen anything like that. Usually when they make a retroactive change, it's in favor of the taxpayer, kind of what I was talking about the whole PPP and ERTC. If there is some kind of tax law change and increase to the taxes, I believe it would be effective 1/1/22, right? So then therefore the end of 2021 is really going to be, the November and December is really going to be crucial in terms of tax planning and figuring out if we accelerate income, defer deductions, that whole mindset. So that's really because we don't have anything concrete right now, in terms of planning and like what to actually do for 2021 versus 2022. And I think at that point, Andy, I can hand it over to you so we can hear about the PPP. Thanks, everyone.
Thanks. I appreciate that. It's interesting information. And can everyone hear me okay, though? Is my mute off? All right. Thank you. So I'm going to talk about the PPP loan. My name again is Andy Allen. I'm a partner in the advisory practice. I have become a PPP specialist over the last almost year now. But my career has been focused on business valuation, transaction services, and litigation support. But today we're going to focus on the PPP loan. And if we can go to the next slide. I'm going to try to be brief here and focus on changes because I think a lot of us on this call that have taken PPP Draw 1 know a lot of the information, a lot about forgiveness, and everyone has their unique circumstances. But in this particular case, things have continued to change, and we do have Draw 2 that have clarified some positions and allowed some additional non-payroll type expenses that we'll talk about here. We'll also talk about eligibility and loan amount calculations a bit as well. But a couple things that are fairly recent. PPP loan expenses now are fully deductible. That wasn't the case in November and December. The law was passed and it override previous IRS position 2032. So just to point out that the loan forgiveness is tax exempt income and the expenses are fully deductible, and that does decrease your basis. So just some warnings out there that we're saying related to this, that the loan forgiveness is not tax exempt until it's forgiven. The expenses are deductible in 2020 in the year that they were incurred, but it could create a basis issue because of just timing issues when taxable distributions in excess of basis for example, and disallowed losses due to basis carried forward to 2021. Okay, so those are some relatively new things. On this slide, we're going to go over quickly just some of the eligible expenses for the PPP loan. What you're seeing on this slide here is really not so new. This is exactly the same that we knew about in PPP Draw 1, where you can use your at least 60% of your loan proceeds on payroll costs, gross wages, and then the other payroll related expenses like healthcare insurance that is employer paid, and that's dental, vision, life, and disability plans. And then retirement benefits that are company paid. It has to be company paid, not any employee paid portion of retirement benefits. And then employer level state taxes in Florida, that's really unemployment. Those aren't really new, but again, something worth pointing on the top bullet here, the new ones are allowed if you have not applied for forgiveness yet. So that's what we're going to look at on the next slide here. So here are the non-payroll expenses. The first few are things we've seen before. There's rent or lease payments in place prior to February 15, interest payments on mortgages, and that relates to both real estate and personal property, utility expenses, but there are a few new things. So covered operation costs like business software and cloud applications. That is something that you're allowed to use in your forgiveness application. We didn't know about that prior to December. Covered property damages costs due to public disturbances. That's not covered by your insurance. Again, not covered by your insurance. That can be something that, if it applies to you, could be used in your forgiveness application. And then supplier costs. Supplies is essential to the operations ordered before the start of your covered period, or perishable goods that count during your covered period. This especially applies to restaurants, for example. And then another new thing is that now you're allowed to use the PPP proceeds to cover worker protection costs, operating or capital expenses that you need to adapt your business to apply with health rules. So we've had questions, what if we're doing more cleaning, for example, than we typically would. If that's not something that's required necessarily by the CDC or some other government entity, then that might not be an eligible expense. Next slide, please. That might be an intangible expense because it's not necessarily required, but you're doing it for the benefit of your customers, for the benefit of people that are, your brand awareness and things like that. So that's the very bottom bullet here on this slide of covered worker protection costs. Intangible assets are excluded, and that's what they mean, something like that. If it's not required, if you're doing it for extra above and beyond type of things, we believe that to be an intangible asset expense. And again, all of these things can be used retro to March 1st, 2020. We didn't know that again, so if you have that ability to look back, we can use these expenses in the 40% part of your PPP loan forgiveness application, the non-payroll expenses. Okay, next slide. Real quick on the second draw here, you have to apply before March 31st of 2021. Some key changes: it used to be 500 or fewer employees for draw one. Now it's 300. The big one that's creating a lot of folks to be not eligible is at least a 25% decline in gross receipts during 2020 quarter compared to the same quarter in 2019. So and there are some nuances to that rule depending on your when you opened. If you opened during 2019, there are some bullets here that you have to be at least 25% in any quarter compared to the quarters that you were open in 2019. There are still restrictions on foreign ownership. If it's a foreign owned company, there may be some trouble in getting approved for PPP Draw 1 or Draw 2. And public companies are now no longer eligible. They were eligible for Draw 1, but now in Draw 2, they are no longer eligible. A lot
of our questions coming in, Andy, are on PPP, so I'm gonna go into that in 1 minute as you wrap up, because most of them are gonna come your way.
Okay, very good. All right, and the receipt of certain grants are also prohibit PPP second draws. That's going to vary industry by industry, company by company. All right, next slide, please. Some other changes on how much for PPP Draw 2. So if you received PPP Draw 1, you're now limited to a max of $2 million. That's still the same calculation of 2.5 times your average monthly payroll of calendar 2019 or the 1 year prior to your application. A lot of folks are using 2020 for that since everyone's applying in January, February, March timeframe here. Again, there's some rules that you can look through if you're a seasonal employee or if you're a new entity. There are still ways to get that loan. It just has a little nuance to how you calculate the loan amount. New for Draw 2 is 3.5 times for NAICS Code 72. So restaurants and hotels can apply for a higher PPP loan amount. And the 300 employee, the 300 employee is by location. So there's certain loans that you can get more, up to, I think, $4 million in Draw 2, depending on how many locations you have and how many, for example, restaurants you might have if you have multiple locations spread out around states. For the loan application, loans less than 150,000, you need to prove out this revenue loss, this gross receipt loss. For loans less than $150,000, you don't have to do that, but you still have the bank will ask for it when you apply for forgiveness. For loans over $150,000, though, they're going to ask for that with your application. Okay, next slide. And the new law also allows you for, if you have not received the first draw, if you didn't apply the first time around, you're still eligible under a lot of those same rules to take advantage of PPP Draw 1. You can still get up to $10 million if you are eligible for that. You can have over 300 employees, but it has to be below 500. and a lot of the rules about the affiliations, and if the other, you can apply for other SBA loans as well. And a lot of customers thought about taking PPP Draw 1 and then decided that they didn't want to go ahead and take that for whatever reason. If they thought that they were performing well enough and didn't want to deal with the certifications about the necessity of the loan, if they didn't want to deal with some of the risks associated with negative press when all the names were released, you can go back and apply for that still using those same kind of calculations and try and get that. But again, it's always worth thinking about from just a risk perspective and from an optics perspective. Do you want to deal with the forgiveness application? And it's worth consulting with your accountants, with your legal team, with your bankers to help make that decision. All right, next slide.
Yeah, I've got. I want to try to get to everyone's questions, or at least try to aggregate them.
Sure.
Yeah, let's jump into it.
Yeah, that's
actually the first one.
The last slide anyway. So if those questions come up, then we'll go ahead and.
Yeah, you'll get the bulk of these. But the first one's for Ashley. It says, for ERTC, can we claim credits? Can we claim credits in 2021 for time paid in 2020 but not claimed? We didn't claim the credit in 2020 due to the PPP exclusion at the time.
Sorry, I was on mute. Yes. So yes, you can go back and you claim the credit, and how you claim it is you amend. It's either your second, third, or fourth quarter payroll form to actually take the credit.
Awesome. Okay, question for Andy. What if the business had over 300 employees in round 1, but now has less than 300 employees for round 2? Can they apply for round 2 if their employees decrease?
So you should be able to, with now being under 300 employees, it might get you in a little bit of an issue where you have some of the loan may not be forgiven if you're having the full-time equivalent reductions. But I think that what we've been doing anyway is looking at some weighted average type calculations to try and help overcome that. There's not specific guidance telling you exactly what to do in that scenario, as has been the theme throughout this CARES Act and the PPP loan, especially. The advice that we give clients is let's go back, let's go through doing what we can with what we know now, and be patient with the new legislation that's passed and the FAQs that are issued, and then we can modify as we go. We're not taking extra risk on by any means, but if there's a gray area, we're just trying to interpret it the best we can, and then wait to see if there's further guidance released. Yeah,
that's been kind of the case where further guidance continues to come out on some of these things, and you just make the best decision you can at the time. Okay, this one's going to go to Ashley. It looks like, does the shutdown by the government order rule apply to both 2020 and 2021?
Yes, that's correct. So it's one of two tests. Either you were shut down by the government order rule, or you had the reduction in gross receipts. And remember, the reduction in gross receipts for 2020 was the 50% test, and for 2021, it's the 20% test.
Thank you, Ashley. I'll probably end up taking this one. Some banks have shut down their PPP portal for PPP-1 forgiveness. What is the status there? So some new forgiveness guidance came out in late January, which were intended to make PPP forgiveness easier for everybody, and especially PPP lenders and the SBA. Andy talked about the under 150, and that did get a lot easier. But at the same time, PPP2 was starting, and the banks had to stand up those processes and put on hold implementing the new changes into their technology for their portals for PPP-1 forgiveness. So you're very likely to see PPP-1 forgiveness come back online in March, by most of the lenders that did the PPP-1 loans and partnered with technology partners to do online portals. So a couple more weeks would be the answer. Ashley, if you got your forgiveness January 5th or December 5th, does it make a difference from a tax planning perspective if you have a calendar year end?
So not necessarily from a tax perspective, right? Because you're going to be allowed the deduction, but the income is not taxable once it's forgiven. The question we've gotten a lot is because audit season is underway as well. So a lot of the auditors are out at the clients right now doing the working on the GAAP financial statements. And a lot of clients, because of course, remember for financial statements purposes, they want to show more income. And for tax purposes, of course, show less. So the question kept coming about is, well, can we show the income on our financial statements this year? And that is not income for GAAP purposes until the loan is actually forgiven by the SBA.
Okay, good to know. Okay, here's a kind of a funny question, a little bit funny, but anybody can take this one. Lots of people are moving from New York, I hear, to Florida. Can you speak to some of the tax advantages of that for the people moving to Florida?
Yeah, sure. So, I mean, basically you can't buy a house in Florida right now from what I hear, because there's an influx of people in terms of, you know, the taxes. And then I also think in terms of how open our state is, you know, with COVID right now. So under the Tax Cut and Jobs Act, one of the changes that were made, which I mentioned, and I don't know if I actually got into it, was this cap on real estate taxes and state income taxes. So what Trump's administration did is they capped out this deduction to $10,000 max, no matter how much you earned, which did hurt a lot of people, because prior to this, you were allowed to write off as a deduction on your tax return the state income taxes you paid, and also the real estate taxes that you paid on your house. And there was really no cap in terms of the dollar amount. So for people in these high state income tax states, such as California, New York, and New Jersey, some taxes, you know, state income taxes they were paying could have been $200,000, $300,000, $400,000, and they were getting the deduction for this, and now they're looking at a $10,000 deduction. So I do believe a lot of people, and then obviously Florida doesn't have a state income tax, so, you know, moving down here, no state income taxes, not losing out on that large deduction. And then, of course, the 80-degree weather as well doesn't hurt.
Certainly. And we have participants from both markets on the line. Another question came, it was a repeat question, but since it came again, I'll try to answer it again. It says, when will BankUnited specifically open the PPP-1 forgiveness portal? And similar answer would be, you know, early March. You can expect that to get back online. Here's a question on some guidance. This could be either bank or CPA. We can or both answer. Let's see. This is more of a statement. It was just said that for GAAP revenues are not recognized until the PPP loan is forgiven, even though monies are going to cover your prior year expenses? Question mark.
That's right. The expenses are from 2020 because that was your covered period, and that's what the loan was used to pay. However, it's coming in. It's not coming in as like top line revenue, I believe, right, Ashley? It's coming in as other income below the line, right, not taxable on your tax return. So it's not, you know, you're not going to add it as a top line revenue number. It would be other income below the operating line after the SBA officially approves your forgiveness application.
Okay, great. We have about 5 more minutes. Let's see, a couple more questions. I have a credit facility with my bank. As I seek to renew my credit facility, what are some things I should take into consideration given, you know, down performance in 2020? Okay, I'll answer that one. Not uncommon. There was definitely an impact to a lot of industries and a lot of companies of the pandemic. I would be prepared to speak specifically to details on how did COVID impact your industry as a whole. How did your company's performance compare to that industry's performance? If you know that information, how did it impact your specific business? Was it a supply side issue? Was it a demand issue? Were you shut down for a certain period of time? Was it sourcing? Was it your vendors? You know, really be well prepared to talk to your bank about what exactly was the impact. Not just, hey, I had a down year, but you know, really getting into maybe monthly financials even, and show your bank, here's my monthly financials for all 12 months, and you could see January, February we were on pace. Then maybe there was 2 or 3 months or more of impact, and then where you've come since, and include January, to the extent that you can include February. I would work with your accountant on getting your CPA year-end numbers done sooner. A lot of people used COVID as, I don't want to say excuse, because we all had other priorities. Doing financials might not have been one of them, but a lot of financials came in really late for 2019. And I think if you work with your CPA and you can get them the information early, they can complete your compilation, your review, your audit. That's also going to help, because when you're talking to the bank about numbers, you're having that as an additional comfort to know that you're on top of your financial reporting, and you and your accountant have completed the year, and you're onward to better times ahead. Ashley, you want to add to that?
Yeah, it's interesting. Yeah, I was just going to say it's interesting you mentioned that, because it's February 18th, and we are, extremely busy right now because we've gotten a lot of financial information in already. And, the auditors are slammed, and even from like the tax side, it feels like people did get organized in 2020. I'm not sure if working from home was a benefit for that. But a lot of people, got it together, and we've gotten a lot of information in the door. So, we're working, getting that done.
Excellent. Okay, I'm going to just give it over to Andy for any closing comments that we might have missed. And then Donna, there's one question on, will the presentation be forwarded on to our guests and participants?
I would just offer, everyone has very, very specific and nuanced PPP questions. You can always reach out to me or Ashley on all the tax questions after this presentation, at our Markham emails or numbers, and we're happy to go through that. And then I'll, throw it back to you, and we can close it up with Donna's question.
Okay, excellent. And really appreciate everybody joining. We had more than 90% of the participants make it through the whole meeting, which is great. Shows Andy and Ashley there was a lot of interest in the topic. We're happy to answer additional questions offline. We'll get you the presentation for our emails, and I'll let Donna confirm that and wrap us up.
Hey, I think, Brian, you did it all. So thanks a lot to Ashley and Andy for bringing us such valuable information today, and to everyone for attending. Have a great afternoon.